Welcome to the SafeSimpleSound podcast, where we believe financial clarity isn't about predicting the future. It's about being prepared for whatever that future holds. Our approach creates both and solutions for the contradictions families face in modern finance. Today, we are continuing our deep dive into understanding risk measurement. If you tuned in to our last episode, we discussed how volatility is the price of admission for growth. But today we are tackling a critical question that keeps many responsible savers awake at night. What happens when the volatility isn't just a wiggle on a chart, but a tidal wave? We are exploring a concept we recently detailed in our blog series, When Normal Isn't Normal, Planning for the Impossible Market Events. Here is the challenge we see in our practice. We face a dangerous contradiction in traditional financial planning. The mathematical models used to manage your money often assume that major market crashes are incredibly rare anomalies. Yet, if you look at history, and if you look at your own lived experience over the last 20 years, you know that these rare events seem to happen with startling regularity. Whether you are 5 years from retirement or 5 years into it, this episode is designed to give you a specific kind of confidence. We want to move you from a place of hoping disasters don't happen to a place where your plan is lie-engineered to withstand them. Drawing from our SafeSimpleSound methodology, we're going to look at the sound principle of integration over abandonment. We aren't going to abandon the math, but we are going to enhance it to reflect reality. By the end of this episode, you will understand why standard diversification might not be enough, and you'll have a new vocabulary for how to protect your family's legacy against the unexpected. Let's begin by establishing a foundation. In the S3 framework, when we talk about being sound, we are talking about structural integrity. A sound house stands up in a storm. A sound financial plan does the same. To understand the storm, we have to talk about a little bit of statistics. Now, staying true to our simple principle, we are going to keep this jargon free, but the concepts are vital. In the traditional financial world, the world of standard brokerage models and basic diversification, there is a heavy reliance on something called the bell curve. You've likely seen this shape before. It suggests that most events happen in the middle, the average days, and extreme events solely on the far left or right are very rare. Under this traditional model, an event like the 2008 financial crisis or the swift COVID-19 crash of 2020 is viewed as a statistical impossibility. The math suggests these things should happen maybe once every 100 years. But here's the reality check. In the last 2 decades alone, we have seen once-in-a-lifetime events happen multiple times. From a SafeSimpleSound perspective, relying on a model that ignores reality is not safe. It creates a false sense of security. In statistics, there are 2 terms for this: kurtosis and skewness. Kurtosis refers to the fatness of the tails on that graph. If the tails are fat, it means extreme events happen much more often than the bell curve predicts. Skewness refers to the lopsidedness of returns. In a normal world, the world of textbooks, returns are evenly spread. But in the real world, the world where you pay your bills and fund your retirement, returns are skewed to the downside. Our team often uses an analogy to make this simple. The market tends to take the stairs up and the elevator down. Think about that for a moment. The climb to wealth is often slow, steady, and requires patience, taking the stairs. But the drops? They can be sudden, swift, and stomach-churning, like pressing the lobby button in a high-speed elevator. If your financial plan is built only for the stairs up, it is lie-fragile. It will shatter when someone presses the elevator down button. This brings us to a core principle: integration over abandonment. When families realize the market can be dangerous, the instinct is often abandonment. Get me out, they say. I can't take the risk. They want to abandon the growth engine of the economy because the ride is too rough. But our S3 framework suggests a different path: integration. We don't abandon the ocean just because there are storms. We build better boats. We don't abandon the stock market because it crashes. We integrate tail risk protection into the portfolio. We aim to build a financial house designed for the sunshine and the hurricanes. This requires a shift in how we measure success. Traditional planning looks at variance, which is just a fancy word for how much prices wiggle around in general. In our practice, drawing from S3 principles, we prefer to look at semivariance. That's the specific measurement of how much things move down. Because let's be honest, you don't lose sleep when your portfolio varies to the upside. Nobody calls our team in a panic because their account went up 2% unexpectedly. The risk that matters, the risk we must architect for, is the downside. We stop asking, what is the average return, and we start asking, what is the survival rate of this plan? This is the shift from fragility to robustness. And to explain how this looks in practice, we need to move from theory to a practical illustration. To illustrate this principle of integration over abandonment, let me share a hypothetical scenario that illustrates how these concepts play out in real life. While this story is created for educational purposes, it demonstrates patterns we see when families apply S3 thinking to retirement planning. Consider a fictional couple. Let's call them Robert and Elena. Robert and Elena are in their early 60s. They have done a wonderful job saving. They have followed the traditional advice. They have a standard, diversified portfolio, perhaps 60% in stocks and 40% in bonds. Their advisor, using traditional bell curve models, tells them they have a 95% chance of success. They feel safe. But then a black swan event occurs, a geopolitical crisis, a pandemic, or a systemic banking failure. It's a Tuesday, and suddenly the impossible is happening. In this hypothetical scenario, because the market is in a panic, the correlation between assets tightens. That means the things that were supposed to balance each other out, stocks and bonds, start falling together. Robert and Elena watch their life savings drop by 20%, then 30% in a matter of weeks. They are stuck in the elevator down. The psychological toll is immense. In this fictional narrative, Robert wants to sell everything to stop the bleeding. He wants to abandon the plan. If he sells now, he locks in the losses, and their retirement timeline is destroyed. Now let's rewind the tape. Let's look at this same hypothetical couple, Robert and Elena, but this time, let's assume they applied the SafeSimpleSound framework before the crisis hit. Instead of just standard diversification, they built a sound strategy that includes 3 specific components designed for the fat tail events. First, they established the Airbag. This is a portion of their assets held in cash or cash equivalents that is mathematically disconnected from the market. It's not there to earn a high return. It's there to absorb the impact of the crash without crushing the passengers. Knowing they have 2 to 3 years of living expenses sitting in the airbag gives them the psychological safety to breathe. Second, they integrated the insurance. In financial terms, we call this convexity. These are assets or strategies designed specifically to go up when the world goes down. While the rest of the world is panicking, this small slice of their portfolio acts as a counterbalance. It's not just distinct, it's oppositional to the crash. Third, and perhaps most importantly, they had a rebalancing rule. This is a pre-signed agreement they made with themselves and their planning team during calm times. The rule states, when the market drops by X amount, we will not sell, we will buy. In our hypothetical S3 scenario, when the crash hits, Robert and Elena are still concerned. They are human, after all. But they aren't panicked. They look at their airbag and know their bills are paid. They look at their insurance component and see it holding steady or rising, offsetting some losses. And then, relying on their framework, they execute their rebalancing rule. They take some of that insurance profit and buy high-quality companies that are currently on sale. While this story of Robert and Elena is fictional, it demonstrates how our framework changes the outcome. In the first version, the volatility destroyed the plan. In the second version, the volatility was actually used by the plan. This example shows patterns we observe when families move from hoping for the best to planning for the worst. Whether you're facing this exact situation or something similar, the lesson is clear. A sound financial plan doesn't pretend the crash won't happen. It assumes it will. Through our SafeSimpleSound practice, we've observed that the families who survive and even thrive during these fat tail events are the ones who accepted that normal isn't always normal. They prepared for the Tuesday that feels like a catastrophe. They moved from being short volatility, where they profit when things are calm and suffer when things are chaotic, to being robust. This aligns with the principle of soundness. A A sound structure bends, it doesn't break. When we talk about the airbag, the insurance, and the rebalancing rule, we are simplifying complex institutional strategies, like tail risk hedging, and making them accessible for your family balance sheet. You don't need a PhD in mathematics to understand this. You just need to understand the concept of the spare tire. You don't carry a spare tire because you plan to get a flat. You carry it so that a flat tire doesn't ruin the journey. As we wrap up this episode on risk architecture, let's summarize the key insights we've covered today. We established that the bell curve models used by many traditional firms often underestimate the frequency of extreme events. The tails are fatter than we think. We discussed that relying solely on stock and bond diversification might not be enough when correlations go to 1, when everything falls together. And we explored through our hypothetical Robert and Elena how integrating an airbag, insurance, or convexity and a rebalancing rule can transform your fear of a crash into a plan for a crash. From our team's perspective at SafeSimpleSound, this is about restoring your agency. When you know you are prepared for the impossible, you can live your life with a quiet confidence that isn't dependent on the daily news cycle. So, what are your next steps? If you want to see the math behind this and see how your current portfolio might handle a fat tail event, we have a resource for you. This episode draws from our recent blog post, When Normal Isn't Normal, which includes a downloadable resource, the Black Swan Survival Guide. This strategic guide moves beyond basic theory. It includes a historical stress test log, a tool designed to help you see how your current allocation would have handled the crash of 2008 or the panic of 2020. It also introduces our tail risk defense strategy in more detail. You can find the full article and the download at SafeSimpleSound.com. Through our S3 approach development, we've created these resources because we believe in educational generosity. If today's S3 insights resonate with your family's situation, we invite you to explore what financial planning could look like through our Safe Simple Sound practice. But either way, whether you engage with our practice or not, you are now equipped with a capability, the understanding that you can build a portfolio that handles the elevator ride down just as well as the stairs up. Thank you for listening to the Safe Simple Sound podcast. Here is to planning that is safe, simple, and sound.